Making sure you have enough money to live comfortably is really important. Naturally, many people want to know how much money they need to live comfortably. However, finding the lowest amount you need to live off any investment involves strategic planning and investment decisions. In this video, I'll show you how you can do that with SCHD. We'll learn a bit about the ETF itself, and in the end, I'll show you 3 strategies, both for the short term and long term. And I'll show you the lowest amount of money you need for each strategy. One of them can even be followed by a college student with little to no investment. First, a quick overview. ETFs, or exchange-traded funds, are like low-cost bundles of investments that you can buy and sell on the stock market just like individual stocks. Basically, they track the performance of a bunch of different stocks, bonds, or other assets. A dividend ETF is a type of ETF that follows a bunch of stocks and bonds that pays dividends. They're great because they let you invest in lots of different dividend-paying companies without having to choose each one individually. And since ETFs spread your money across many companies, if one company doesn't do well, it won't hurt your overall investment too much. One of these ETFs is the Schwab US Dividend Equity ETF, sponsored by Charles Schwab. It started in 2011 and tries to copy the performance of large U.S. companies that are considered good value investments. It's a big ETF with over $52 billion in assets, making it one of the largest ETFs that focus on these types of companies. So how does it work? This ETF doesn't have a fund manager picking stocks actively. Instead, it follows a set formula, and the portfolio can change over time. So if you invest in SCHD, you have to trust in Schwab's approach. SCHD looks at companies that pay dividends and are part of the Dow Jones US Dividend 100 ETF. But it's focused on picking companies that grow their dividends over time. It looks at a few things before adding a company to its list. Like 1, the company has been paying good dividends for at least 10 years. 2, it's worth at least $500 million and is easy to buy and sell. 3, it doesn't have too much debt compared to how much money it makes. 4, it makes good profits compared to the money it's invested. 5, it currently pays a good dividend. 6, it's been increasing its dividend for the past 5 years. And 7, it doesn't include real estate investment trusts, or REITs. Also, it doesn't let one company make up more than 4% of the whole portfolio, and no single type of company, like tech or healthcare, can be more than 25%. And remember, if you're putting your money in SCHD, you have to trust Schwab's way of doing things. There's no one actively managing the fund, so the portfolio can change over time. Over the past 5 years, SCHD hasn't performed as well as the S&P 500, especially after the pandemic, but this could be an opportunity to get in at a good price. The goal of the fund is to match the total return of the Dow Jones US Dividend 100 Index, and it doesn't charge much in fees. In fact, recently SCHD has bounced back impressively, gaining 14.3% since hitting a low in October last year and reaching its peak by today's pricing. When it comes to investing in dividend stocks or ETFs like SCHD, it's important to consider future yields. Right now, SCHD's forward yield isn't very high, sitting at 3.5%. This is lower compared to what you can get from U.S. Treasury bonds, which are offering between 4.62% and 5.37% because of higher inflation. However, because of the ups and downs we've seen in the past few years and the uncertainty ahead, trying to outperform the market with SCHD might not work out as expected. So while I still think it's a good idea to buy SCHD for long-term diversification, it might be smart to wait for prices to go down a bit and for yields to improve before jumping in. And that's where you can use the 3 strategies that I'm going to show you at the end of the video. Each of these 3 strategies is adjusted so that it needs the lowest amount of investment required. Back to the ETF. SCHD recently updated its portfolio, which happens every year and is adjusted every quarter. Some stocks were added and some stocks were removed based on the previously mentioned criteria. Let's take a look at what changed. The ETF removed 23 stocks. Some notable stocks that were removed include Broadcom and Federal Agricultural Mortgage Corporation. Broadcom has been doing well, with its dividends growing at a rate of 17.5% over 5 years, even though its starting yield was low. AGM also had strong fundamentals and recently raised its dividend by a whopping 27.3%. But not all removed stocks were big losses. Companies like 3M and Paramount Global have been struggling. Para even got a junk rating for its long-term debt, and 3M's dividends haven't been growing much due to financial troubles. This makes room for new entries. In fact, the ETF has added 23 new stocks. Some new additions stand out, like Cincinnati Financial Corporation and Bristol-Myers Squibb. CINF has been doing consistently well, growing its revenue and dividends for over 63 years. BMY also looks promising, with a good starting yield and growing dividends. Overall, SCHD follows a specific formula for its portfolio, and if you believe in that formula, it can be a good investment. It's managed to do well without relying on big tech stocks like Apple or Amazon. But still, some people criticized the recent changes, saying some added stocks have fallen in the short term. But these stocks still have strong fundamentals, so they could do well in the long run. And this brings us to the most important chapter, the dividends. The current dividend yield of SCHD is 3.5%, which might seem lower compared to other investments like business development companies or REITs that we often talk about. But the real value of SCHD is in how much its dividends grow over time. Over the past 10 years, the dividend has grown by a huge 402%. Even over the last 5 years, it's been growing at an average rate of 11.8% each year. And over the past decade, it's been growing at around 10.87% annually. If SCHD keeps growing its dividend between 8 to 12% like it aims to, that's pretty great. Plus, SCHD has been consistent with its dividend payments. It's grown its dividend for 12 years in a row now. Most people invest in a dividend-focused ETF like SCHD because they want a steady source of income, and SCHD has definitely delivered on that front, providing growing dividends that are also tax-efficient. For example, if you invested $10,000 in 2012, at first, you'd only be getting about $313 in dividend income back each year. But now, thanks to the growth, that same investment would be giving you over $1,400 in dividends annually, assuming you reinvested all the dividends you received. But there's a downside to relying on high dividends. It takes time for those dividends to really add up. If you're close to retirement or already retired, you might not have the luxury of waiting. You might need more income up front rather than waiting for dividends to grow. For these situations, SCHD's downside is that the starting yield of 3.5% typically isn't large enough to produce any meaningful short-term income, and dividend growth isn't nearly as important. Even if an investor had $1 million worth of SCHD, the dividend income would amount to $34,000, which still falls below the median income in the USA, and surely isn't enough to support the cost of living in most medium and high cost of living cities. In the end, I'll share 3 different plans for both short and long terms. I'll tell you the lowest amount of money you'll need for each plan, and guess what? One of them can be done even if you're a college student with hardly any money to begin with. Now, before showing you the strategies, here's my final takeaway for SCHD. The ETF is still a great investment for investors who want their dividends to grow a lot. Some popular companies got kicked out during recent changes, but being popular doesn't always mean being the best. The new additions to the portfolio are high-quality companies with a history of strong dividend growth and plenty of cash flow to support them. Even though the starting dividend yield is 3.5%, which is on the lower side, the real magic is in how much these dividends grow over time. Based on past data, we can expect them to grow by 8% to 12% each year. While the total return of a regular stock market index might be higher in the long run, SCHD can give you a lot of income for your retirement years, especially if you hold on to it for a long time and keep putting more money into it. And now, On to the strategies themselves. To figure out how much money you'll need for retirement, start by thinking about what you spend now. On average, in the U.S., one person spends about $3,400 each month, which adds up to around $40,800 a year. This covers things like housing, getting around, food, and healthcare. But remember, things will get more expensive over time because of inflation, so you can't count on $3,400 being enough for the rest of your life. As time goes on, you'll need more money each month to cover your expenses. Let's say we look back at the past 10 years, and we see that prices have gone up by about 2.65% each year. That means in 30 years, you might need around $7,000 each month, or $84,000 annually. Keeping that in mind, let's break down our first strategy, which we're going to call the Year 1 Goal, or the lowest amount you need to get paid from the very first year. To figure out this amount, the calculation is pretty straightforward. You divide the amount of return you require, which in our case is $3,400 times 12, by the current dividend yield of the ETF, which in the case of SCHD is 3.5%. For SCHD, if you want to live off dividends right away from the very first year, the amount of investment you need is around $1,165,714, which will pay an annual dividend of $40,800 or $3,400 per month. But let's be honest, most of us don't have such a huge chunk of money sitting idle for this type of investment. However, we can compensate for the time it requires, and this is where strategy 2 comes in, which we're going to call Future Retirement One-Time Investment Strategy. This is the lowest one-time investment you need to retire in the future. Let's say you have 30 years until retirement. In that case, our target will be $7,000 each month or $84,000 annually. To calculate this, we're going to use our JMA calculator. This calculator takes the initial investment and grows it by the average annual share price gain. Then, the dividend is calculated using the dividend rate of a stock. This dividend is then reinvested and added to the total amount, called the year-end new balance. The next year, the same process is repeated. The only difference is ensuring that the dividend growth value is also accounted for. For this, the next year's dividend rate is increased by the dividend growth rate. For this strategy, John needs to invest around $25,000 in SCHD, which after 1 year is projected to be valued at $27,740. In 10 years, it's projected to almost triple to $74,571. Moving on to 20 years, this is projected to reach $257,118. And at the 30-year mark, John's initial investment of $25,000 is projected to reach an impressive $1,081,919, paying an annual dividend of $85,793 or $7,149 monthly. In total, this ETF grows his portfolio by $1,056,919, which includes $523,850 from the rise in stock value and $533,069 from dividends reinvested over the years. Even though these numbers seem very compelling, what if you don't have $25,000 as startup capital? Well, for this case, I have the most startup-friendly strategy, which we're going to call monthly retirement strategy. And to completely live off SCHD using monthly contributions, you need to invest around $225 each month, which is $2,700 per year. Here's the breakdown of this strategy if you keep on investing for over 30 years. After a year, this investment is projected to be valued at $5,696. In 10 years, it's projected to reach $54,898. Moving on to 20 years, this is projected to reach $240,177. At the 30-year mark, John's monthly contribution strategy will take him to an investment valuation of $1,067,796, paying an annual dividend of $84,458 or $7,038 monthly. In total, this ETF grows his portfolio by $984,096, which includes $482,623 from the rise in stock value and $501,473 from dividends reinvested over the years. Now listen, if you want to grow your wealth, watch the video on the screen to see how to turn a $100,000 investment into $20 million.